Hey Bowtie Nation, Joseph Hogue here, and options trading has exploded as investors realize the power of these investments to lower your risk, leverage your return higher, even create constant cash flow from non-dividend paying stocks. According to the Options Clearing Council, retail investors traded more than 23 million call options in 1 week last year, and total daily options volume more than doubled from just a few years ago. And it's easy to see why. For example, shares of GameStop surged 155% in just 2 weeks last March, but the call options at the $150 strike price surged 1,000%, multiplying your money by 10 times. Another example, I've been buying shares of SoFi Technologies, ticker SOFI, since May of 2022, with the stock up 26% since then, but not without a roller coaster ride with the stock up double digits, only to crash back several times. But through the covered call strategy, one of the 5 I'll show you today, I've been able to reduce that risk and bank $48,000 cash flow in just 2 years. But for many investors, options are still like a foreign language. In fact, many of the beginning options investors I talk to are losing a lot of money. Researchers from the London School of Business studied options investment by retail investors between November 2019 to June 2021 and found the group lost over $1.14 billion on total trades and an additional $4 billion on hidden trading costs. The table on the left here is option trades by non-institutional investors, showing the top and bottom 10 in cumulative profits on option contracts. And what is really amazing here, though, is that even in those top 10 stocks that produced positive returns on the options investments, factoring in the trading costs meant investors still lost money in 5 of the best 10 stocks. So to help you make money, I want to highlight 5 simple option strategies to get you started. Whether you're just starting with options or have been using them for years, these are simple enough anyone can understand them, but powerful enough to do some amazing things for your portfolio. We'll start with one of the simplest option trading strategies, and one of my favorites, the covered call, which not only creates income from any stock, but will also lower your risk. I'll explain option terms and the basics next, but the covered call is where you own a stock. See where it says you're long 100 shares, and then you sell a call option against that position. That does give another investor the right to buy those shares from you at a set price, which does cap your profit potential you see here in the chart, but it also offers some benefits that are too good to pass up. I'll use SoFi Technologies for our example, and you can see we can buy the shares for $7.15 each here. The bank is becoming a major player in fintech, and I like it long term, but looking at the price chart just in the past 2 years, you see that roller coaster up and down. I started buying shares in the price range right around $5 in 2022, but it's been back down into the 4s, up past $10 and back below 7, and all of those moves happening very quickly. So the covered call is one way I can reduce my risk and still get a great upside return. That's why I use this strategy, but you're going to see how it can produce some great cash flow as well. So for example, if I buy 100 shares at $7.15 each, I can use these January call options and sell the $10 strike price for 71 cents each. That means another investor is going to pay me that 71 cents a share right now for the right to buy the stock from me at $10 each from now until January expiration. Now, there is a downside to this that I'll explain later, but the upside is massive risk reduction and cash flow immediately. Collecting that 71 cents a share against the stock price of $7.15 means I get an immediate 10% cash return. SoFi may not pay a dividend for years, but I just turned it into a dividend stock, paying 10%. I also reduced my risk in the stock, effectively cashing out part of the cost with that 71 cents collected. Of course, the downside is if SoFi jumps past $10 a share by January, that other investor with the call options is going to buy them from me at that price. It's why you see the profit capped in the chart here, but that $10 price would amount to a 40% return in just 8 months on top of the 10% cash I collected, so that's just fine by me. If the stock doesn't make it to that $10 by January, I keep the stock and the money collected and can sell another call option against it. And this is exactly how I've collected that $48,000 cash profit over the last 2 years, holding 16,000 shares of SoFi and regularly selling those new call options against them. I'll show you an option strategy that beats any dividend stock next, showing you how to get 10% and higher cash yields. But first, I want to explain option basics here. If you've already been using options, you can set it at 2x speed or skip ahead, but stick around because later I'm going to show you the 3 ways options will supercharge your investing. Here, options give you the right to buy or sell a stock for a specified price on a specified date. Buying a call option gives you the right to buy shares of a stock, while put options give you the right to sell that stock. Let's look at an example because it's really not as complicated as it sounds. Here we see the options for shares of Apple, which is trading at $181 a share right now. Across the top here, you can see there are options for different dates from June through August and even years further out. These are the expiration dates, so how long each set of options lasts. Most stocks have options that expire each month and then longer dated ones that expire in January of each year. Some of the most popular stocks and funds even have options that expire every week or every day. So these options with the expiration date of January 17th, 2025 give me the right to buy or sell shares of Apple on that date or before, about 8 months from now. And the price I can buy or sell those shares is called the strike price, seen here in the middle of the table. Each of these rows is a different option for the shares at that price. For example, in the middle here at $180, the option is going to give me the right to buy or sell shares of Apple for $180 each in January. And that is no matter where the shares are by that point. If Apple is trading at $200 a share in January, I can still buy it for that $180 each if I have this option investment. So you can already see how this can be a powerful investment. Options allow you to buy a stock for less than the market price sometime in the future, or we're going to see later how you can sell it for more than the market price. Now, of course, you don't just get that ability to lock in a stock price for nothing. To buy an option, you pay here what's called the premium. Here on each side of the strike price, you see the bid and the ask columns and the last price at which the option was traded. The bid is how much someone is willing to pay for that option in the market. The ask is how much someone is willing to sell it for right now. But we're going to get to those later. If we look at the $180 options again, that last price of $17.35 on the left here is the price you pay per share for that ability to buy those shares of Apple for $180 in January, no matter where it's at trading around that date. So for example, let's say you did buy these call options on Apple at that $180 strike price. Now each option contract is for 100 shares, so if you buy 2 contracts, you'd actually be getting the right to buy 200 shares of Apple. If you paid that last price here of $17.35 a share, that means you'd pay $3,470. That's $17.35 times 200 shares right now to buy that call option. If shares of Apple rise to $250 each by January, you can buy the shares for $180 each because you have those options. So you would pay $36,000. That's 180 times 200 shares for the shares that are immediately worth $50,000 each, or 200 shares at $250 in the market. Now, in fact, most option traders don't actually put up the money to buy or sell the shares when the options expire. Since those options would be worth around $14,000 as you get closer to the expiration, that's because whoever owns those options can immediately turn them around for that profit. Then the options traders would just sell the options before they expire. Now, you'll also notice within each of these options, the price changes for different strike prices up and down the table. For example, if you wanted to lock in that price of $165 per share for Apple up to January 2025, you'd have to pay almost $28 a share to buy those call options. But if you want to lock in the price of maybe $195 per share, you'd only have to pay $10 each for those options. And of course, the difference in price is because of where the market price for Apple is right now. Obviously, at $165 per share, with Apple now trading at $181 per share in the market, that's a great deal, and it could get even better if the stock price keeps moving higher. So any investor that's going to sell you those call options, they're going to want more money for that. On the other hand, those call options for the right to buy Apple at $195 each are above the current price. There's some risk that the share price won't even make it up to $195 by January, which would make those options investments worthless. So any investor buying those options isn't going to want to pay as much, so you get that $10 premium. Again, Nation, I know it's a lot of numbers to throw at you and a lot more to come with those other option strategies. Do not feel like you need to understand these all at once. I think it took me the better part of 2 years to really feel comfortable with options, but when I did, I never looked back, and I have used them constantly. Watch through the video a couple times or just specific parts if you need to. Understand what's happening in these strategies, and you're going to have an investing tool that will make you money. This next option strategy, the cash secured put, may look like a covered call from a profit or loss perspective, but the pros and cons are very different. You set this up by selling a put option against a stock, and I'm going to show you an example to help explain it better, but here you don't even need to own the stock. You sell a put option and collect that cash without having to do anything else. We'll use SoFi again as an example to compare it against that covered call strategy, but these option strategies are going to work on any stock. Here, if I sell that $8 strike price puts on SoFi, I collect the $1.78 per share. Now remember, this means another investor is paying me that $1.78 per share to be able to sell the stock to me for $8 each from now until January. Now, this cash secured put strategy is best used on a stock that you wouldn't mind buying, because if the stock price is below that put option strike by expiration, that other investor is going to use that option to sell it to you for that price. So I'm going to be on the hook to buy shares of SoFi for $8 each, and in the meantime, I'd keep that $8 a share in cash in my account just in case. That's why it's called a cash secured put, because you have that cash needed and ready. But think about what it also means. I've collected $1.78 per share right now on an obligation for $8 a share. That's like a 22% cash dividend in just 8 months, and I'm set to win no matter what the stock does. That's because if shares of SoFi rise above $8 a share, that put option is going to expire worthless. The other investor wouldn't sell the shares to me for $8 if he can get much more selling it in the market. In that case, I'd keep the $1.78 per share, wouldn't have to do anything else. I could even sell another set of put options and collect more cash. In the other scenario, if the shares remain below $8 each, then the other investor uses that put option and I buy them for that amount, but that's fine because I was going to buy the stock anyway. This way though, if you take the $8 I ended up paying for the stock minus the $1.78 I collected selling those puts, it's like getting shares for SoFi at $6.22 each. That is a 13% discount to where the stock is trading at right now. And in that case, if I do use the cash in my account to buy those shares, I can then turn around and use the covered call strategy to keep producing that cash flow from the position and keep that upside when the stock rebounds. The next strategy will make you money whether a stock price goes up or down, but check out the launch of my Ultimate Options course for all 29 option strategies. The option trades in this video are some of my favorites, but in the course, I'll take you step by step into 29 strategies, including one that will make your money back fast in a losing stock. Whether you've never invested in options or already know the basics, this course will teach you everything you need about using options to increase returns, lower your risk of a crash, and even generate income every month. Over 3 hours of videos, I start with the basics, then walk you through each option strategy, when to use it, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy and an options calculator to show you exactly what to expect. Right now, I'm launching the course at a 38% discount. Save $150 off, but only for the next 3 days. You'll get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. Now that $150 launch discount is only available with the coupon code in the link I'll leave in the description below, so look for that link or scan the QR code here. The next 2 option strategies can make you money whether a stock price goes up or down. First, I'll explain the strap strategy, which is set up buying 2 call options while also buying 1 put option. The strategy works best when you expect a stock to move a lot. You aren't sure in which direction though, but you think it's more likely to move higher than lower. For example, if you expect important news to come out or around an earnings report that could either sink the company or drive it higher. I'll use ChargePoint Holdings, ticker CHPT, for our example. The leader in EV charging has been a monster around its earnings reports, falling double digits in the days around 3 of the last 4 earnings and surging 25% in one. Now, I do own shares of ChargePoint. I think it has a strong advantage in that EV charging, the bottleneck in EV adoption right now, and with Tesla firing all its supercharger employees, ChargePoint could have an opportunity to pick up market share and surprise investors when it does report on May 28th. So as an investor, I hope the next move is higher, but given that history around its earnings reports, the only thing I do know is the stock will move big time, one way or the other. And that's where the strap option strategy comes in, allowing me to profit whether the stock price moves higher or lower, but with a bigger profit to the upside. So if I'm using the $2 strike price here on options for June 21st expiration, so that's going to encompass that move around earnings at the end of the month, plus time for momentum to take the shares further. I'm going to pay at 16 cents per share and buy 2 of the call options for every 1 put option at 42 cents a share. So here I'm spending $32 or 16 cents each for those 2 call option contracts worth 200 shares, plus $42 for the put option contracts worth $100 shares for a total $74 investment. And you can see this payoff looks exactly like the setup chart. If shares of ChargePoint crash with a bad earnings to $1 a share, the strategy would make $28 for every 74 invested, or a 38% return in less than 2 months. If ChargePoint finally has a good quarter and shares rise to that $2.50 a share by late June, I'll be up $22 on every 74 invested. The only risk here is that if the earnings are just so-so and the stock goes nowhere, but even then, the most I can lose is the money I used to buy those options. Now, this and the next one are risky strategies, especially if done on a stock that moves up or down as much as ChargePoint, but it's a great example of how options can help you make money without even having to know which direction a stock is going to go. Similar to the strap is the strip strategy, but this one is for when you believe the odds are better that a stock price is going to fall. Here you're going to buy 2 put options for every 1 call option you buy. So again, that 2-to-1 ratio and ahead of some expected news or earnings that are going to take the stock much higher or lower. We'll use Tesla here for this example. Shares are down 35% from the last year's high, but with Musk's increasingly erratic behavior, it could still go either way. Now, the next earnings release is until July 17th, but I'm going to use the January options to give the stock more time to find some news that sends it in one direction or the other. I'll use the $180 strike price, and remember, this is buying 2 put options and 1 call option, so we're going to pay $25.15 for each of those put options, $50.30 for both, and then $36 a share for the call options. Altogether, we pay $86 per share for the strip strategy through January. And here you see the payoff with the option trade making money if the Tesla rises or falls by that January expiration. You're making money if the price of Tesla rebounds past $266 or falls below $136 per share. Now that's a pretty big move, 26% to the downside or 43% to the upside. So I wouldn't necessarily wait until January to take my profit on this and close out the position. With any of these, you have to decide when to take that money and run, or whether to hold the strategy all the way through expiration. Our next strategy is perfect for getting your money back fast on a losing stock, but a lot of investors think options are really only about risk and leveraging your returns higher. In fact, you might be missing out on 2 of the most important uses for options, so I want to briefly outline the 3 main goals for options investors and how to do more with these investing tools. And of course, making more money is part of options investing. For this, options are perfect because they do increase your leverage on a stock. You could spend the $900 for a single share of NVIDIA, and as we see here, it was up 3.3% on the day, so you would have made a $30 profit. Or if you had paid just $42 a share for the $920 strike May call options, you would have made 31% on that same day. Now, of course, that increased return isn't without the risk. You could also have lost your entire investment in those call options, and for a lot of investors, that's all they see when they think about options. But options can also be used to lower your risk in a stock, or even lower your risk against a broader stock market crash. Buying a put option against a stock you own, also called a protective put, effectively removes all the risk below that strike price. It doesn't matter how far the stock price falls, you can sell the shares at that strike price with the put option. And it's not just those simple put options, but option strategies. We've already seen how that covered call strategy effectively lowers your risk by transferring some of that stock's risk to another investor, while also putting cash in your pocket. Which brings us to our third goal for options investors, generating that income. And you're going to notice that some of these option strategies can do double duty, creating that cash flow as well as lowering risk. I want to get back to our option strategies list, but look in the video description below for more videos on options basics and strategies. If you've ever been so far down on a stock that you just wanted to make your money back, this next option strategy, the stock repair strategy, is perfect. Not only will it help you make your money back on a losing stock, but even turn a profit, even if the stock price doesn't jump higher. I know the graph here looks confusing, but I'll walk you through an example of this. Assuming you already own the stock, you'd set this up, buying a call option and selling 2 call options at a higher strike price for every 100 shares you own. In the example, I'll show you how this gradually lowers your cost in a stock even if the price doesn't rebound, and makes your money back fast with just a small bump in the shares. Here again, I'll use ChargePoint Holdings, ticker CHPT, because I know a lot of you are like me, holding the stock with a higher cost basis. Now my cost basis so far is $1.92 each, which would fall to $1.60 with these covered call options I sold against it, but what if I hadn't? What if I were sitting on those shares of ChargePoint down from a $1.92 cost basis and just wanted a way to make my money back? Now remember, for the stock repair strategy, we'll buy 1 call and then sell 2 calls with a higher strike price for every 100 shares we own. For our example, I'm going to buy the $1.50 calls and sell 2 of the $2 calls, but you could also do this with maybe the 2 and the $2.50 options. Just understand what's happening here. I'm selling 2 of the $2 calls for 42 cents each, so collecting that 84 cents and using that to pay for the 64 cents for each of the $1.50 strike call options. That means I both collect a net 20 cents per share and totally pay for those $1.50 call options. And then the payoff chart shows how this works to help make your money back fast. Since you collected that net 20 cents per share, that lowers your cost for the original shares. No matter what the stock price does, even if it falls further, you're going to have offset some of that original cost. Do that enough times, and your cost basis is going to fall down where the stock is at now. If the stock rises, though, those call options you bought that were totally paid for, they start making your money back fast. Here you can see I start making money on the position at just over $1.60 per share, having made up all the lost ground and then some. Now, like that covered call strategy, my upside is capped here, but it's a small price to pay for making your money back and then some on a losing stock. Get your $150 discount code for the complete options investing course, 29 option strategies, plus the strategy finder and the calculator. Get that special coupon code with the link in the description below, and always know you're using the right option strategy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.